Trinidad and Tobago, and welcome to the Bourse Report. Well, this week we continue to dissect first quarter results, and today we're speaking about Greece Kennedy Limited as well as Unilever Corporation Limited. Now, both groups would have reported improved earnings in overall, with some fine details in between. Let's take a look at what those groups would have reported for their first quarter and what investors might expect in the coming months ahead. Turning firstly to Greece Kennedy Limited, well, for their first quarter of 2026, the group would have reported a diluted earnings per share figure in TT dollar equivalent of 10.6 cents per share, which was a 6.3% improvement from the 9.9 cents recorded in that prior comparable period of 2025. Driving that performance was an improvement of 7.4% in total revenues, moving from 1.97 billion odd TT equivalent to just under 2.12 billion TT dollar equivalent. Expenses also up 6.3% from 1.89 billion to just over 2.01 billion. Profit from continuing operations improving a very healthy 22.5% from 132 million to 162 million. After considering non-controlling interest, net profit attributable to equity holders ultimately increasing that 6.1% from 99.1 million to 105 odd million for that first quarter in TT dollar equivalent, of course. Now, when we take a look at segment performance for Greece Kennedy, there were some notable changes as well as some fairly stable segments. Money services, for example, maintained its relatively same level or degree of profitability over the comparable quarters at around 22 million TT equivalent. Food trading, the group's largest segment in terms of profit before tax contribution, marginally declined just about 1.2% from 111 odd to 110 odd million TT dollar equivalent. The main changes in terms of positive drivers came in that banking and investment segment, which almost doubled, well, in fact doubled, increasing just over 100% from 11 million TT odd equivalent to just about 22 odd million TT dollar equivalent, as well as insurance, which grew just around 10%, going from 21 million in that prior comparable period in terms of profit before tax in that first quarter of 2025 to just around $23 million TT dollar equivalent, of course, in that first quarter of 2026. Also impressive in terms of GKC's performance for this first quarter of 2026 was a recovery in its margins or profitability margins, operating profit margin in that pinkish segment, recovering from 6.7% in that prior comparable period to just about 7.7%, while profit before tax margin also improved from 7.1% to 7.4%. So in terms of all of the indicators with respect to revenue growth as well as operating profit margins and profit before tax margins, it does make for good reading for Greece Kennedy investors. So at a price of $3.58, the stock is trading at a price earnings ratio of about 12 times, which is slightly above the conglomerate sector average of 11 times and offers investors a dividend yield of 2.8%, which is below the sector average of 4%. However, one of the important drivers in terms of Greece Kennedy is that it does remit its dividends to investors in US dollars. So on the basis of steady revenue growth, those continuing higher margins, the US dollar dividends, but of course overlaid by continuing economic uncertainty in the regional space, was maintaining a market weight rating with a stable outlook on Greece Kennedy for the time being. Turning very quickly to Unilever Corporation Limited, or UCL, well, for its first quarter of 2026, the group would have reported a total earnings per share figure of $1.29, which is a whopping 108% increase from that 62 cents reported in the prior comparable period. Now, take this with a grain of salt. There was a fairly heavy, significant one-off gain from discontinued operations baked into that earnings result. Earnings from continuing operations actually declined 9.1% from 44 cents in the prior comparable period of 2025 to 40 cents in the most recently concluded first quarter of 2026. Revenues from continuing operations, however, were up 15.2% from 61 to just about 70 odd million. Operating profits after restructuring costs declined 11.1% from 16.8 to 14.9 billion. And overall profit for the period, which does include that one-off gain, did improve that 108% from 16.2 to 33.7 million. Now, when we take a look at revenue trends for UCL, we can see that it has made for good reading over the past few comparable periods, increasing 6.7% over first quarter 2024 to 2025, and now most recently 15.2% from first quarter 2025 to 2026, growing from that 61 to 70 odd million dollars. And from a profitability perspective, however, not as strong in terms of margin strength. we can see that gross profit margins fell from 50.7 to 42% in that greenest segment. Operating profits as well declined from 20.3% in that yellowish column to 21.3%, meaning that for every dollar of revenue generated in the eyes of investors, the company is translating that into marginally less returns in terms of operating profit rather, when we look at that yellow segment. So at a price of $15.94, Unilever does trade at a price-to-earnings ratio of 6.9 times, which is below the sector average of 8.5 times. Now that includes those one-off gains. Excluding the impact of one-off gains, that price-to-earnings ratio would be closer to just about 20 times, and it offers a dividend yield of a very healthy-looking 59.2%. Compared to the sector average of 10.8%. Again, for investors, take this with a grain of salt because that dividend yield includes fairly significant special dividends which would have been declared and paid based on the divestment of certain business lines. So on the basis of higher revenue generation, margin moderation, a relatively attractive dividend yield even on a normalized basis, and that question mark over of course, the optimistic outlook for improved normalized performance versus maintaining its market weight ratio, or rating rather, on UCL with a stable outlook for the time being. But that's it for this week's edition. For more information, you can give us a call at 2BORSE or 226-8773, email us at info@borsefinancial.com, or visit our website at borseinvestment.com, where all of our research is absolutely free, and you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. And finally, before I leave, I'd just like to let the investing public know and our clients know that we have relocated our Port of Spain offices from Gala Street to our new offices on Cornelio Street on Arbit Avenue. And you can visit us there, check us out, and of course, get some really good investment advice and make more informed investment decisions. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.